Now, we've got an exciting panel for you, being led by the indomitable Andrew Edgecliffe-Johnson. He is the U.S. business editor at the Financial Times, has been 20 years at Financial Times. He's also a writer with Moral Money and writing a lot around business education and sustainability, sustainable finance, and a variety of other topics. We also have a terrific investor panel for you, and you have their bios in your pamphlet. So I'm not going to go through the bios, and I know that Andrew's going to introduce them, and you'll hear a lot from them. But I want to, say, first of all, we appreciate you all coming and being part of this, but also the work that you're doing on behalf of sustainable finance. So without further ado, Andrew and team, thank you.
All right, I'm not used to having an obedient class of students who listen to my words, so newspaper audiences tend to be a little rowdier, but thank you, Toss, for that introduction.
Mike is not on.
Okay, does that work? It's overwhelming. All right, it goes downhill now. I'm delighted to be here with this group because there are very few subjects that animate our readership at the FT more than this one at the moment. And by our readership, I mean bankers, I mean asset managers, I mean asset owners, private equity firms, central bankers, regulators, everybody from university endowments to business school students. It is an extraordinarily broad church at the moment. And this is not just in New York, it's not just in London, it's in Brussels, it's in Tokyo, it's everywhere that we operate. And so we've been trying to capture the extraordinary breadth of this subject. And I think the spectrum of stories that come under these banners of ESG, sustainable investing, impact investing, stakeholder capitalism is dizzyingly broad. But it's become clear to us the problems these are seeking to address, from a climate crisis to a populist crisis of confidence in business and finance, will probably only be solved through some sort of coordination between these different groups. So it sometimes feels that at the FT we've been writing about stakeholder capitalism since Milton Friedman was in short trousers, but it also really feels as though the conversation changed a lot in the last couple of years. Last year in particular, we felt the momentum shift. We could see the money shift, most importantly. And I think that's represented in this room to some extent. From the Business Roundtable in Washington to the Institute Directors in London, there is this sense of urgency now and a new mood that wasn't there before. So this, as Tanzi mentioned, prompted us last year to launch a newsletter, a new platform called Moral Money, which tries to capture this kind of suite of subjects, not just for one audience, but for that whole group of audiences that I mentioned. And it's taken off like a rocket, which has been very gratifying, obviously, but it's also told us quite how much appetite there is for the subject and quite how much uncertainty there still is. People are grappling with a lot of these themes. It's really not that simple. And there strikes us that there are a number of questions hanging in the air. And if last year was the year the momentum shifted, this year really feels like it's shaping up to be the moment of truth, where we find out how much of this was rhetoric, how much of it is real. There are some very big questions still lingering after all of the pledges, the letters, and the statements. With all of the diverse pressures on them, what should companies and investors prioritize? Divestment campaigns going to change the economics of industries as large as oil and gas? Or is engagement and stewardship going to be the way to go? Will the thicket of different ESG metrics ever get thinned? And most pointedly, after the market volatility and very real disruptions to business of the last few weeks with the coronavirus, how many of the good intentions that have been articulated in a bull market are going to survive the next big crisis or the next big downturn? And having raised so many stakeholders' expectations that the world is going to be different now, how much disillusionment will there be if it isn't? So that is a very daunting list of questions, but I am delighted to be joined by a panel that's unusually well placed to answer them. in no particular order, I'm going to introduce, well, in some particular order, I'll attempt to introduce. To my immediate right, Marc Khouzami, who's joining us from DWS Group, Deutsche Bank's asset management arm. Michelle Dunstan, Global Head of Responsible Investing for AllianceBernstein. Marc, just double checking here. Marc Hayes, Director of Sustainable and Impact Investing for Glenmede. To his right, Kevin Smith, VP with the Sustainable Finance Group at Goldman Sachs, and stepping in very kindly for a colleague of hers, Sonia Kim, MD and ESG Product Lead for Truecost, which is part of S&P Global. So, as Tansi said, you have all of their bios, so I'm not going to start off with much of an introduction, but instead I'd like to ask each of you to give us just a very brief overview of how your organization is approaching the challenges of sustainable investment, sustainable finance, and which initiatives you're working on right now that you think are the most promising and interesting. Sonia, can I start with you?
Can't use the elbow for that one. Good morning, or good afternoon. I'm Sonia Kim, I'm with Truecost. Thanks for the introduction. So how is S&P Global embracing our sustainability and ESG initiatives? I guess there's two parts to it. One is at the corporate level. There are a number of initiatives that we've engaged in. I can talk about some of the more recent ones in the last year. Our CEO recently became signatory of the Business Roundtable, along with 200 other CEOs, in signing the statement for the purpose of corporates. We also have launched a campaign last year called Change Pays to highlight the importance of women and their impact in the workforce. And we also published our first TCFD report back in February. So at the corporate level, we're heavily committed to being a leader in embracing our own sustainability goals. From an operational level, and I probably won't be able to articulate this in 2 minutes, but we've got 4 divisions. We've got our ratings division, we've got our indices division, Platts, and then we've got market intelligence, which is where I sit within. And hopefully all of you have some knowledge and background around what S&P does, but Ratings obviously has launched their own analyses of green bonds over the last few years. Last year, we launched an ESG evaluation. Platts is starting to do more around using their expertise around the commodities markets to unveil trends within energy transition. Index, we just actually celebrated our 20th anniversary of our sustainability index, the Dow Jones Sustainability Index. We've also launched about 123 index products since then. And then last but not least, market intelligence, which I'll talk more about later, but we're obviously very heavily invested in building out solutions to help the marketplace understand climate and environmental analytics.
Thank you. So, Kevin, give us the picture from Goldman right now.
Thanks. So for Goldman Sachs, we've had sustainability to some degree at kind of the core of what we've been doing for a long time. We started our journey way back in the early 2000s under our two prior CEOs ago. Hank Paulson was very focused on the environment and led a lot of our early initiatives to develop a lot of, in many ways, were our kind of internal approaches, which I don't think was it was foreign to a lot of companies starting out with their kind of operational sustainability objectives. And over the time period, though, I think we've realized that there have been many more signals around the commercial opportunities related to our activities. So in 2010, we launched a dedicated clean tech business within our investment bank. 2012, we launched our first firm-wide target of $40 billion of financing and investing in the clean tech area. 2013, we saw the kind of the first foray into the green bond market on the corporate space, and we've been playing in those markets for many years now. 2015, in and around the Paris Agreement, we spent a lot of time internally revamping our efforts, came out with our newer target, at that time $150 billion to expand on the prior 40 that we had already achieved. We also at that time acquired within our asset management group a company called Imprint Capital, which was a dedicated ESG investing business. They had about $500 million of assets. Today we manage over $60 billion of assets that are dedicated in ESG. So quite a growth opportunity there. It's not just climate or environment related for us. We have a long-standing commitment to investing in underserved communities through our urban investment group, having deployed almost $8 billion of balance sheet capital into those markets. And so there has been a long history of some of the activities that we've done. In July of last year, we as a firm came together, our new CEO, David Solomon, and formed what is now my group, the Sustainable Finance Group. And it's meant to bring a lot of those different pieces together across the bank, help coordinate things internally, act as a resource for all of our efforts. The announcement of our group followed a new firm-wide target that we put out for $750 billion of new financing, investing, and advisory activity over the next 10 years. And so in many ways, over that time period, I do think that the commercial relevance and the commercial impetus that we've seen from our clients has really picked up. We were joking earlier this year, earlier before the panel, it felt like the last 6 or 12 months, the focus on sustainable finance has really increased across the board from both our corporate investing clients. So I personally spend a little bit more time with our investment banking clients, and so talking about corporate or municipal capital raising efforts within the bank, but we have a number of colleagues that spend time on investment or on the market making side of our business as well.
Marc, that's the setup for you. The focus is increasing.
It is. And even before I talk about our core business, I want to almost define the space and our philosophy for why we think this is important today. And I think it's always good to start with that, given how much jargon and slang is in this space and everyone talking about it in a slightly different way. So for us, sustainable and impact investing, it's all around how you use ESG information. And there's a number of different ways you can do that, a number of different approaches. There's this idea of using ESG to make a better investment decision, and there's an idea around using ESG to create impact. And really, for us, we think about it from almost an investor motivation standpoint. Rather than leading with a whole bunch of slang and terminology, we think about it from a motivational perspective. So think about it from risk mitigation in terms of an investor goal. That usually feeds into this idea of ESG integration, so how you're actually linking in material ESG risks as part of your process. Then there's an idea of unlocking growth opportunities using ESG, and that's usually this idea of, some people call it ESG mandated. Again, thinking of ESG as part of your objective. And then the last part really is impact. If you want to create a measurable impact around environmental and social problems, some of the big issues you talked about, Andrew, at the beginning, that's this idea of thematic or impact investing. And usually dialing it down to that level, I think helps everyone level set in the room. For us, Glenmede's been in this space for a very long time. It's part of our core DNA and our ethos, working with mission-aligned foundations we've been doing for decades. But we've seen our ability to design whole portfolios across those approaches that I just mentioned really evolve over time. And that's a number of different reasons, right? I mean, for us, you go back to 2001, it's when we really first started buying ESG data and integrating it into some of our portfolios. You go to 2014, it's when we formally launched this group and hired a dedicated team around it. But through that time, it was still more of a niche opportunity, more of this idea of addressing this in a sleeve. And the big difference today is that it's the whole portfolio. And clients come to us and say, I want the entire portfolio to have aspects of this embedded in some way. And we're able to do that now. And the biggest reason is data. I'm sure we'll hear about it from Trucost's side, but 10 years ago, you could be pounding the table around wanting to integrate ESG, and it would have been hard to do. A lot of that data wasn't out there. Last thing I'll say is around some of the niches I'm excited about. Certainly from a data perspective, I think we're going to talk about later some of the research we're doing around diversity and climate change, but specifically diversity and looking at a few different levels of it, both socioeconomic and at lower levels of the organization. I'm really excited about. I'm also excited about some of the firm initiatives. So it's really important in this space to walk the walk as an investment manager. As an organization, we also want to be supporting and embedding aspects of ESG. So there's a number of initiatives that we're rolling out this year.
Very brief follow-up. Tell us a bit about the client base at Glenmede. Who you serve?
Yeah, so it's a mix. So it's anything from high net worth, private wealth, individuals, family offices, as well as endowments, foundations, and institutions. So it really does span that spectrum. And that's why it's really important to be able to offer that breadth of approaches, because it's not a one-size-fits-all space.
Michelle, How are you tackling this at AllianceBernstein?
Sure. So for those of you who don't know, AllianceBernstein's a relatively large global asset manager. We have about $650 billion of assets under management. And we take a three-pronged approach to ESG and sustainable investing. So the first, which a lot of my colleagues here have mentioned, is looking at our own corporate responsibility practices. If we're going to be asking portfolio companies to do things differently, we should be doing those things ourselves. So we are looking at everything from our corporate governance to our diversity and inclusion to our own climate change footprint or carbon footprint to what do we look like when we evaluate our supply chain for issues like modern slavery or forced labor. So that's prong one, is we need to behave the way we're expecting our portfolio companies to behave. The second is across all our actively managed portfolios, we do integration. And we do it because ESG integration, because we actually believe that it translates into better client outcomes and helps the world too. Why wouldn't you want to take into all the potential information into account when you're making an investment decision? So what we do is we arm our analyst and PM teams with the data, the information, the tool sets to be able to do this. They're ably supported by a team of expert ESG analysts when the analysis and the decisions and the issues become thorny. And we do innovative things, which I'll talk about in a second, like our partnership with Columbia University on climate change to try and deliver better training and better information to our analysts and PMs. And then the last thing we do is for clients that want a product that goes above and beyond simple risk and return, we have a suite of what we call portfolios with purpose. All of these portfolios have very specific ESG goals that we report and measure those goals in addition to traditional risk and return. So let me talk about two or three things that we kind of like right now and we think are very innovative and kind of differentiated. So the first is our partnership with the Lamont Doherty Earth Institute at Columbia University. These guys are on the cutting edge of climate science. They have paleoclimatologists, tree wing scientists, sea level rise guys. And what we've done with them over the course of the past year is develop a curriculum that we are putting every single one of our investors in. All our analysts and PMs are going through this training. And it's a day-long session, which is done in cooperation with Columbia that involves their scientists and some of our finance professionals that tackles not only the basics of climate training, but how you would think about applying that to decision-making, analysis, investment, and portfolios. And then let me just talk quickly about two new types of strategies that we're launching, which are part of our portfolios with purpose. So one is our suite of what we're calling the Green Alpha products. So we have one that exists in Australia right now, and we're on the cusp of launching a global and an Asian product, which are carbon neutral strategies. So these are versions of our existing products, but are actually literally carbon neutral. So that's going to appeal to a different or potentially new set of clients. And the last product is one that I'm actually the portfolio manager for. We've been running it for, I guess, about a year and a bit now. It's called Global ESG Improvers. So while we do think there's a place to invest and we need people investing in new technology, they're going to manage that climate change transition, we also think we need to address the world today. So this is focused on helping companies do better. So companies that are improving along an E, S, or G dimension today. And we can demonstrate that that actually generates alpha. It's not so much do you get a good score on the MSCI or other kinds of ratings, it's does your score improve. So this is focused on the companies that are improving.
That's a great motto. We need to address the world today. Just very briefly before I throw to Marc, you mentioned some of these new products. Obviously, not all of them are launched, but what's the appetite been like? What's the take-up been like among clients?
Yeah, it's very interesting. So, the total suite of portfolios with purposes started out very small, but it's one of the most rapidly growing parts of our product suite. And where it's truly differentiated, we have a Muni Impact Fund, for instance, that is very, very popular right now. So it's slower in the US, very popular in Europe, very popular in Australia. The products are all growing rapidly, but they're still a small percent of our overall asset base.
Yep. Okay, Marc, how are you tackling this at DWS?
Sure. So I think it's going to be a very similar story to what you've heard from some of the other financial institutions. We've been doing this a long time. And similar to Goldman and maybe some others, where about 6 years ago we had pockets of things, people doing sustainable things across the Deutsche Bank company. We basically aggregated that all together into one spot under sustainable investments, and that's where we've put all of our alternative products. we also have active products and passive products, and that sits in different areas. I happen to sit in the alternatives business within our asset management company. And then in sustainable investments, what we've done there is aggregated all of the, as I said, aggregated all the products we have, and that spans everything from social finance and financial inclusion, so think microfinance, global microfinance products, to a lot of environmentally focused strategies, and that is everything from lending to Africa, agriculture, for agriculture in Africa, to energy efficiency in Eastern Europe, to we've a couple of different strategies focused in Asia, particularly in China, clean tech, growth equity, renewable energy investment at the project level. So we do have a whole host of different products. And one of the points that I think Marc had mentioned on this spectrum of, starting to integrate, just screens versus being more proactive, being all the way full impact. The area I sit in, and again, we run the gamut, right? We have screens in some of our passive products, all the way to where I sit, which is more on the impact side, where we're trying to be more proactive about what we're doing, which is, in particular, the most recent product we launched was in what I spend most of my time now focused on is corporate sustainability. We launched a product with Apple and about a dozen of its suppliers to invest in renewable energy in mainland China as a way to address their Scope 3 emissions, Apple's Scope 3 emissions in their supply chain. And so again, being very purposeful about where we put that capital, being very additional and saying we're going to add clean energy to the grid and as a way create that impact. And all doing that, we achieved two things, right? We addressed a Scope 3 carbon footprint, and we also delivered economic returns, or this is active, so are delivering economic returns to the investors, which are the suppliers. And that's where things we're most excited about. Personally, the things I'm most excited about is the work we're doing in corporate sustainability, because we do believe that there's a huge opportunity not only to bring financial investors back into the fold, as we've been mentioning, but to bring corporations to the table. And there's a need now for corporations to really address sustainability broadly defined. And our view and our thesis is that that can be done where we can achieve those sustainability goals very transparently, very proactively and directly, but also achieve economic returns alongside that.
Okay, so we've all read Tonzi's work and her team's work, which has established scientifically, unimpeachably, that there is a return on sustainability investment. But somehow not everybody seems to have bought into this idea. There are still people, I still meet these strange people out there who think, surely there must be a trade-off. Does anybody on this panel want to daringly contest the idea that there is a happy, positive return on sustainability investment? Oh, Michelle is grabbing reaching for the microphone. Okay.
I think people have a mistaken view of what sustainability investing is. They think back to exclusions, that if you're excluding a third of all potential investments, by definition, you're narrowing your universe and you're not going to be able to have outperformance all the time. That's not what sustainability investing is. So I think most people who are of the belief that it doesn't generate returns are just thinking, I'm never gonna invest in an oil and gas company, I'm never gonna invest in tobacco, I'm never gonna invest in anything that does anything bad, and I've just excluded a third of the market, and therefore I can't generate returns. That's the wrong approach.
We should come back to it because that's a great theme. Kevin.
Yeah, I would just add, and this came up a lot several years ago with discussions with clients, particularly on our asset management side. We would get the same reaction, like, how do you expect me to make a market return or alpha with one hand tied behind my back? And one of my colleagues used to say, it's not one hand behind your back, it's actually adding a third hand. And so in many ways, you should be looking at ESG as a lens by which, and the way we look at it is very similar to the way you described it, was there's kind of three components. There's how do you use other non-financial data to identify risk, right, embedded within your portfolio? How can you use other data sources to identify operational efficiencies in a portfolio? Or on the other spectrum is how can you use other data sources to identify cutting edge themes that are good economically that you can play in at the right time? But it's an investment discipline or a lens by which you evaluate those sorts of things. It's not magic pixie dust that you just sprinkle onto a portfolio and all of a sudden there's alpha created, right? I think there's a misconception to what ESG is in many ways.
Yeah, I think the one thing I'd agree with both those statements, and I think that I'd add is basically, I think to the point you were saying, and what I've seen is this slightly different routes. People have this, ESG, I'm doing good. No, you're finding risk, and you're shielding yourself from that, as you're saying, Kevin. And I think from and again, I sit in the alts space, so we take a little bit different approach because it's not, we're looking at listed equities, we're looking at private assets and private companies, and there's generally been this view of, oh, it has to be concessionary because clearly they can't be, generating the same returns because they're doing something that's environmentally positive. And what we would argue is that has long gone, right? I mean, the fact that the cost curves have come down, scale is being achieved, and now what we see is renewable energy is producing market rate returns. You have water technology companies, recycling companies, all of these companies that are producing positive environmental outcomes, all generating market rate returns. And that's based on looking at any other private equity firm that's out there. So I think it is a misconception. I think people are stuck in what has been historically the case, or a historic misconception. I think people are stuck, and trying to get them out of that has been is a bit of a challenge.
I think the other thing is there is a little bit of headline risk in this space. And Andrew, you're very good. I've read your pieces, but there is sometimes an issue where you just see this blast of ESG funds underperform or ESG funds outperform. Actually, both can be equally dangerous because it's all around what type of approach are those funds taking, and over what period are you actually measuring this? This is a long-term discipline. So there's always going to be periods in the short term where maybe they don't for a variety of reasons. I'd also say that any sort of headline like that around just looking at ESG funds as a whole, it's kind of too broad of a statement because this is a space all of us agree. It depends on how you're implementing it. Are you looking at the right data, and are you implementing it in a robust way that's actually embedded or not? And that's why there is some real alpha opportunity in this space. But just a one-size-fits-all approach just doesn't work. So I do think it's just important, again, on the educational side to help clients really sift through what's real and what's not, and exactly what that means when you're saying outperform versus underperform.
Damn, I was just about to ask Sonia a really broad question about how S&P's data shows the broad universe of ESG funds are performing.
Well, thank you for the segue, actually.
Maybe you can refine that for us.
Well, I mean, I agree with everything that's been said here, and I do think a lot of the research, people can poke holes in it and say it's got limitations, but just to talk about some of the work that we've done in the last year, we have a quantamental research team at Marc Intelligence, and we actually used true cost data recently to publish a report in December. And what our findings were that when we looked at three portfolio's within the S&P. So we constructed three portfolios based on the S&P 500 constituents, where we looked at carbon sensitivity, low, medium, high, and we compared their performance against that. And some of the key findings that we found were that, one, the most profitable companies were actually the lowest in carbon intensity. Again, this is the S&P 500, so I recognize that it's a limited universe, but this is just some research that we've done. The second thing that we found from this study was that the companies that had the highest carbon sensitivity, meaning they had the lowest carbon intensity, they actually had other climate characteristics that were quite positive. So they were actually the ones that had the highest reductions in water use, in waste production, as well as obviously carbon emissions. So that was another finding. And then the third was that when we actually looked at fundamentals and returns, they were equal, if not slightly higher than the baseline or benchmark performance. So that's actually one study that we just did recently. A couple of years ago, we did a similar study in collaboration with Stanford and Yonsei University, where we actually gave our true cost data sets to this research team. And what they did was they looked at using S&P indexes. We looked at the S&P 500 index and compared that to the performance of a carbon efficient version of the index, as well as a fossil fuel free version of the index. And actually, we found that those carbon efficient and fossil fuel free indices outperformed the baseline portfolio as well as the benchmark, not just over 3 different time horizons, so 1 year, 3 year, and 5 year. So that's really putting data to use to study this that you're talking about. Are investors compromising returns? And I'm sure there are studies that would show the opposite. But just based on what we've been, we're eating our own cooking.
Yeah.
This is what we're finding, and so that's if that's something that's going to help incentivize. But I also think it is an education. You have to ask investors, what are their goals. So that's not obviously touched on in this analysis, but I think it's something that needs to be discussed further.
I want to briefly come back to Marc. You talked about the risk mitigation component of the calculus that your clients are employing here. Do you see that rising up the agenda? Are they more driven now by risk by headline risk, if you like, as we see more and more headline attention to these issues?
Yeah, there's a couple different lenses of it. I think one, from just a true fiduciary aspect perspective, particularly if you're dealing with, let's say, an ERISA type plan, just given some of the language that's out there from the DOL in terms of being able to lean on how you integrate ESG from a materiality standpoint, the risk mitigation argument really resonates with that crowd right away. They understand that. It's just another fundamental factor right alongside it. The other thing I would say is that if you look at some of the recent events, and again, headlines are important here, the PG&E issue is one that came up again and again in terms of conversations that clients were asking about this. And that was an E issue, right? And what we saw actually was that there was some dispersion in terms of managers that were able to catch it, that said they were ESG managers, and then others that said that weren't able to catch it. And this is public that's out there. But one of the managers that we have on our platform, they did. And the way they caught it is actually by looking at different sets of data, unstructured sets of data that weren't available in the big providers, and using that. So leading with examples like that, people always talk about BP, which was 8 years ago. People talk about Facebook on the social lens in terms of data and cybersecurity as an S issue. The PG&E one, I think, is what has really turned the tide in terms of a lot of investors asking us around, okay, well, I understand that. That's risk mitigation. If you can avoid that, how else can we do that across the portfolio?
Funny how individual headlines can have that effect. But, Michelle, I want to, in the next round, if you like, I want to dive a little deeper into some of these subjects that the five of you have touched on. You raised this idea of the global ESG improvers. And these are not the companies that started off with a shiny, happy, make everybody happy type business model. These are kind of, I assume there's things like fossil fuels companies and, like. There is a very vocal group around every one of those companies arguing that investors just shouldn't touch them, that everybody should divest. How do you navigate this debate as an investor when, there are people out there, when responsible investing does not mean the same to everybody?
Yeah, and that's just it. It doesn't mean the same thing to everyone. So we do have products like our global sustainable thematic product. We have equity and credit versions that do not invest in fossil fuels. It's not sustainable. It's not part of those businesses. So for clients who are extremely opposed to oil and gas companies, we have products that meet their needs. On the other hand, if you want to look at it from how do we move the world forward, I do think we need these sustainable products. We do need investments in new technologies that are going to drive the world forward. There are plenty of funds, including some of our own, that deal with that. On the other hand, a lot of those funds tend to ignore the way the world is today. So just take oil. Only 30% of the world's oil goes into passenger vehicles. So even if we moved to a 100% electric vehicle world tomorrow, we still need a lot of oil. And what do you think powers those electrical vehicles? It's mined commodities like nickel, manganese, cobalt, lithium. And how do you actually plug in your car and charge it up? You need more energy. So rather than ignoring these particular aspects of the market, we want to engage with the companies. Let's force the companies that are going to be here, and they're going to be here for decades, they're not going away tomorrow, let's force these companies to do better. It's unrealistic to think that the entire oil industry is going to disappear overnight. So rather than not dealing with it, we as large stewards of capital have the power to meet with the boards of directors, the CEOs, the strategy people to say, look, if you're going to be an oil and gas company, here's how to be a good oil and gas company, and demand things like rules on flaring, methane capture. Let's push them in the right direction. And that's what Improvers is about. If the product is necessary for the world today, we'll engage with the companies and try and make them do better. If it's not, we won't invest in it. So take tobacco, for instance, in this particular scenario. We had analysts try and pitch us e-cigarettes. This was before all the more recent bad stuff about e-cigarettes came out, but the idea that e-cigarettes are a better alternative to regular cigarettes. we kind of said, yeah, but that would be better if the whole thing just went away tomorrow. And what would be the downside? You'd have some unhappy people, but health outcomes would improve, costs would go down. We're not doing that. If oil went away tomorrow, the world would be basically in chaos. So it's something we're going to have to deal with for the next 20, 30, 40, 50 years. We'll engage with the companies and try and get them to do better.
That's interesting, because I've certainly met tobacco companies who are trying to make that analogy, but they're just the same as oil companies. Marc, I don't know if you want to pick up on that question about engagement as a long-term steward of capital, but I had another question for you about metrics. So do you want to weigh in on that, or should we move on? I was going to ask. You talked about metrics for diversity and inclusion, for example. Yeah, I often hear there are just way too many clashing metrics out there already. Nobody knows which ones to pay attention to. Why would you design your own?
So we're not designing our own. What we're doing is really looking at a couple different lenses. First, and I think all of us can agree, you have to look at, is it a material indicator or not as a whole? Do we care if a company is more diverse from an ethnic and a gender perspective? The answer is yes, we do. There is a ton of data supporting that fact out there, that more diverse companies, more ethically diverse companies are better companies over the long term from a corporate financial performance perspective. Full stop. Now, how do you actually measure that? What are the most important metrics to look at to tie into that indicator? So one of them is from a board level and a leadership perspective level. So you're looking at the composition at the board in terms of women or diverse people of color across the organization in that way at the leadership perspective. But what if you looked at one layer down? What if you looked at people across the middle levels of the organization, or even in terms of their hiring practices? And even more important than those hiring practices, how those people are empowered, retained, and promoted over time. And those are types of stats that you can get from companies increasingly slow. Speaking of corporate stewardship, there's been a lot of different proxy votes and corporate engagement around this issue, asking companies to disclose more of these types of statistics. So suddenly, if you're able to measure the inclusivity of a company, which is what some of these metrics are getting at, that is a very powerful tie into financial performance. So that's one thing that we're looking at. The other angle we're looking at is, I've talked about gender lens, I've talked about ethnically diverse. What about diversity of thought? So certainly those first two things I said help you achieve that, but there's a third way to achieve that, which is socioeconomic diversity. And we've started to explore this idea, and there's been some really interesting studies out there that show some of the large companies that are out there, they really have a lacking in terms of socioeconomic diversity in terms of the types of educational backgrounds, the type of upbringings people have had, and it does create a little bit of groupthink. So can you look at companies from a statistics perspective of how do they hire their talent? Do they all gravitate to the same one or two schools and hire just from that pool? Or do they have a wider way of actually sourcing that talent? Do they look at certain skill sets or ways of thinking versus just the pool and the education you come from? And suddenly that's really, really interesting, because there is a strong tie to socioeconomic diversity to financial performance.
And how hard are you finding it to get your hands on that kind of data from the outside?
Extremely hard. So again, data is the key. And that's where alpha is created in this space. It's around really who can achieve the most diverse and the most material sets of data. And some of it is using specialist data providers, not only gravitating towards the large ones, which are very important, but trying to complement with that some specialist providers that are out there that are sourcing unstructured sets of data, using AI, using machine learning to do so. Also, your own proprietary fundamental analysis. Just like any other sort of concept around fundamental analysis, this is a space that demands attention from that side, from active asset managers.
So I don't know, Sonia, whether S&B Global has a database yet of how many companies recruit only from NYU Stern, but if not, you clearly should. But can I ask you to come in on this question of metric overload, which we hear a lot? The alphabet soup of GRI, SASB, TCFD. You're obviously S&P Global is among the companies that have created their own data sets. Do you see any kind of coordination coming, any sort of standardization around which ones we should actually pay attention to?
I hope so. I think when we talk to our clients, the key pain points that they echo over and over is there's not enough data, there's not enough quality data, there's infrequency of data. And then you talk to another client and they say, there's too much data. I don't know what to do with it. So, as you look across a lot of these frameworks, there are obviously overlaps. So hopefully we're going to move towards some kind of convergence and standardization, because that's going to actually, I think that's at the heart of accelerating progress. You know, you hear about, you know, survey fatigue. You know, if we can solve the standardization problem and you have companies doing something once, it's going to incentivize more and more disclosures. The truth is, a lot of companies aren't equipped to even start disclosing their own emissions. They don't know how, so they need help. I'd say on the investor side, a big gap also is we have the data, we've been collecting the data, we're buying the data. What do we do with it? We don't know what to do. It's just a static point in time data point. And what they're looking for is they're looking for forward-looking signals, right? So, I mean, some of the work that, without sounding like I'm making a plug here, I mean, some of the things that we're trying to do to answer those questions for our clients is, you know, how does credit risk look, for instance, right? Starting to overlay things like unpriced carbon into a financial model and looking at what impact that has over 3, 5, 10 years. Another way to think about forward-looking is, I mean, on climate. I think one of the things that we have to really address right now, the most urgent thing, is really around climate change. And more customers are saying, I need to be able to measure what my assets are going to look like in 5 years. If there's a high likelihood that my assets are concentrated in high climate hazard zones, I need to know what that is. And so we're actually looking at that. We're researching it. We've recently launched a physical risk data set. But really the next step is then translating that into financial impact. And I think that's really the next step.
I can imagine that's fertile territory right now. So, Kevin, I just want to hear from you. We've heard a lot about the environmental challenge. How is this transition to a more environmentally sustainable way of doing business going to be financed? We write about green bonds as the kind of pioneers of this, but we're clearly going to require larger pools of capital. You know, where do you see that coming from?
Yeah, I think, I mean, right now, if you think about equities and debt is by far a much bigger universe. And so, you know, the conversations that are having with corporate clients, municipal clients, has primarily been on the fixed income side and raising capital in that form. Green bonds is one and probably the most, you know, prevalent form of doing that, given it's been around the longest. But then you're seeing, you know, that translate into other products, social bonds for social projects, sustainability bonds, a combination of the two. More recently, linked products like either in the loan market or there's one example in the bond market with the Enel SDG linked bond. And so I think there will be ways in which companies are, for a couple of reasons, tying their mission and some of their sustainability objectives to the way they raise capital. But in many ways, it's another form for them to, you know, get better pricing in some cases. And I think in the last, I mean, maybe it gets back to the inverse of your question on return on investment. You know, for many, many years, primarily those types of structures had been a benefit to diversifying their investor base for certain investors that wanted ESG products. And in many ways, it was more of a PR or marketing way for companies to talk about what they're doing. I think in the last, call it 3 to 6 months or so, we've seen much more tangible evidence of pricing benefits for issuers that are doing that. Now, some of that may just be a supply-demand dynamic, and maybe that changes over time. But you know, to the extent that those markets are open, I think companies will take advantage of it to raise capital against the projects that they need to finance. And you know, there's been no dearth of companies that are coming out with these longer-term targets, whether it's net zero or renewable energy goals. They're going to have to figure out a way to finance a lot to things, both internally or through
I do love the
partnerships.
2050 targets.
You know,
I'm not sure any of us are going to be here to judge those companies.
You know, Marc's
30
mention, Marc's mention of their partnership with Apple, I think, is a great example of that. In you know, looking at how they can invest across their supply chain for rolling out their Scope 3 emissions objectives.
Yeah, Marc, I mean, I want to ask you, you know, as companies look at this challenge of making their business more sustainability, they have their existing operations clearly, which they're reviewing. But what role is investment in new operations and M&A going to play in this transition?
Sure. Yeah, I mean, you know, like I think it's going to be a combination of all of it, right? I think what happens is, you know, a lot of companies, and I'm probably preaching to the choir for a lot of folks in the room, but they're going to invest in their own operations by, as Andrea from Invest Industrial was talking about, you're going to reduce your own carbon footprint. But there comes a point, and depending on sustainability goals that companies are setting, they may not be able to do that solely through the investment in their own operations, right? What ends up happening is there may be a need for increased scale of a particular input that they don't have control over. And you're looking into supply chains, and maybe the supply chains don't exist today. Or maybe they exist, but they don't exist at a scale that's sufficient for, let's say, like a Danone to go and actually change an entire product line. They just need more. And the reality is that it's only coming through additional capital coming to the market, and that's both debt and equity. And where I agree with you, I think from the debt market, there seems to be a lot of appetite and a lot of interest. I think that exists as well in the equity market, a little bit harder to get it in, but I think that's where the interesting opportunity for corporations to step in and say, look, we're going to lead on this, and I think there's a real opportunity for corporations to step into that lead and bring financial investors alongside, whether that's foundations, whether it's endowments, pension funds, more traditional financial asset allocators who can come in alongside those corporations, and all of a sudden, that's how you're opening up scale. That's how you're creating a huge impact because you're bringing all that capital into bear. And so I think that's, it will be a little bit of all of it coming together.
Okay, so my next question is for all of you. I have no idea where the S&P 500 is right now, but
Down, probably.
Thank you. Okay, in the wake of the last few weeks, we have amazing market volatility. We have a very real, tangible crisis in businesses are having to handle, which affects everything from their employees to their supply chains. It is a reminder that this whole debate about different ways of investing, of financing, of conducting business has taken hold in a bull market. The conditions have been amazingly positive for more than a decade now. Is that going to survive the next crisis, the next downturn, whenever it may come, whether it's this or something else we haven't thought of? And what should companies and investors be doing to ensure that it does survive, if you think that it's important? Who wants to take that?
I'll start from, again, spending the last few years particularly really focused on corporate sustainability. And we've heard kind of repeatedly throughout the day, one of the big drivers of that is consumers. Right, and I think, yes, there's some legislation that's happening. Yes, there's some things in the market. But the real drive, people talk about the Business Roundtable, and Jamie Dimon gets great, but the real drive of all of that is bottom line. And the real drive of that is coming from consumers. Consumers are now changing. Consumers are saying, look, I demand environmentally sustainable product. I want good product. I want product that I can believe in socially. I can believe, from an ethical perspective. They're not only demanding it, now they're willing to pay for it too. And they're changing their buying behavior. And that is what's going to that's going to force this to stay. Because I don't think that the average consumer, unless you see a massive, again, barring some catastrophe here, even a small crisis, even a recession, I don't think consumers are going to change their view in wanting to see sustainable product. Maybe they say, hey, I'm not going to pay as much for it now, but they will still demand it. And companies will still have to achieve that level of sustainability in order to maintain their customer base and maintain their clients. And so I think that is what's going to drive some staying power from a sustainability perspective.
Yeah, I would agree that, if you think about the direction of travel, we're kind of headed one way. Younger people are more in favor of sustainable investments than older people. I don't think that trend reverses at any time soon. So maybe there's a little blip for a year or something, but what we see is sustained momentum, sustained change. And I actually think we're on kind of that upward slope of the S curve now that we see demand for these products accelerating. And if there's a commercial imperative and the investors of tomorrow want this product, that's something that we're going to have to deliver. And in terms of the companies ourselves, I think it might weed out people who are paying lip service to it, who are just slapping labels on things, who don't truly believe that this is real, from companies who have embedded it in their culture. Most companies, or ones that are truly practicing it, believe that this is a way to deliver better outcomes for our clients. Not only products that people want, but in considering the multitude of factors in making your investment decisions, you're making better decisions, which is producing better financial outcomes. If your investor base and your analysts and PMs truly have embedded that and believe that, they're going to continue to doing this because it's good business sense, whatever kind of market you're in.
Maybe even more so.
It should be interesting to watch because I think when you look at the largest study out there around ESG funds over a very long period of time, and again, I hate the headline risk and I hate picking out one study, but what I like doing is talking about this meta study that exists. So it's a study of studies. It's a study of 2,500 different studies since the 1970s around if you embed ESG in a robust way, what does it look like from an overall performance perspective? And the data supports lower volatility profile, less steep drawdowns. And, most of the data doesn't go back through 2008, but it does go back in Europe if you look at 2011. And in general, across a very large set of funds that integrated ESG in a robust way, there is this suggestion that there's a lower volatility, less deep drawdown profile. So it'll be interesting to see how that data goes through this period. The other thing I would say just broadly, to echo those points, is your question kind of assumes this is viewed as a nice to have, and frankly, we're just not seeing it that way anymore at all. It's a must have.
I'm not quite that cynical, but I thought it was just provoking. Kevin.
Yeah, I might just add, and I agree with many of my colleagues here that have mentioned, I think kind of the one twist that Marc mentioned on the consumer side, I think is also relevant for companies. And so, in many ways, economics still rule, but you're seeing really good investable opportunities that, also are sustainable, right? If you're procuring power, renewables in many cases are cheaper than other forms of power. So that, I think, lasts through the cycle because there's an economic driver for that. I also think many of the companies, again, maybe they're the ones that Michelle mentioned are kind of more core to them. They have these long-dated commitments. Some are longer than others, but if you have a 2030 commitment, you have reputational risk to achieve that. So I think some of those drivers will, continue to get companies to invest in these things. And look, the market's going to have these gyrations. We always do. The last week, a lot of people are solely focused on the coronavirus. There's also a lot of technicals that said there's probably a good time for a correction in the market, given the bull run that we've seen. And so there's always going to be some short-term market gyrations, but I do think a lot of these trends are more secular in nature and are going to, are going to continue throughout, some of that disruption.
And one thing I just add quickly on that, you talk about renewable energy. If you think back to 2016, and not to go political, but in the end of year 2016, people thought renewables were going to go the way of the dinosaur. People were like, whoa, I can't touch this. But for utilities. And why? Because they're looking at 50-year assets, they're looking at 25-year assets. They don't make decisions on market short-term market gyrations. They're looking at long-term planning, and that's where you see that kind of, again, the fundamentals have moved that way, and so I think that will continue.
Point. Sonia.
I guess I'd add by saying I think it's going to also come back to the availability of data and information. Investors will increasingly, or should increasingly, think about, what is Apple's supply chain look like? I mean, just based on what we've seen in a very short period of time with coronavirus over the last few weeks, we've seen, huge impact on the labor markets. We've seen the markets completely decline. This is just a microcosm of what could happen with any type of, catastrophic event or a market downturn. And I think it's investors demanding more transparency around what does the company that I'm investing in, what does that supply chain look like? And of course, that's difficult today because that's top secret. That's competitive advantage, that's IP. But I think there should be more of a demand for that. And then it is gonna come back down to having information about the companies you're investing in. And similarly, on the other side of that, companies will need to understand what potential impacts and downside risk is and plan accordingly. And you can only do that with
All right.
analysis.
I want to give the audience a chance to come in with some questions here. I'm going to start at the back, and if you could just wait till the microphone gets to you. Tell us who you are and where you're from, and whether you want to direct your question to an individual on the panel.
Okay. My name is Steve McCarthy. I run a family office. I'm involved in Stern at the impact investing space for 15 years. First, an observation and a question. The observation I have is that when you look at both philanthropy as well as social impact, I would think there's a continuum of compassion in terms of returns, profiles, impact, and whatnot, whether it's a 5% payout ratio and no returns to social impact to PRIs and whatnot. So it's looking through the lens of not the investor only, but the impactee. That's useful in some cases to have this. The question, Amy Dominy left her job at KLD about 30 years ago, and it's found the domain index, sin stocks and whatnot. It's been 30 years now, and I guess probably there's still a substantial amount of funds in the space, but there's also a small piece over the overall private and public equities in the space in terms of social. I'm curious about the attribution analysis that's going on. Like for instance, using S&P as a proxy, how many companies have gone from 2000 to 2020 to show the guidelines, ESG guidelines, and how do you make attribution that exactly that performance relates to the guidelines and the changes in the guidelines? How do you look at ESG from those lenses in terms of who is really making change and creating alpha in that regard, whether it is attributable to ESG or other things that are going on in those companies? And that could be private companies, public companies, or whatever. It's a measurement kind of thing, attribution kind of thing. I'm just curious.
Is that a question for me then? Yeah, sure. I mean, I'm happy to. So I think one of your questions was who is leading the charge in getting this data out there? Was that?
How do you attribute the changes in ESG if the companies have gone from no guidelines, an S&P company, no guidelines in 2000 to 2020 with their guidelines? A
Sure.
lot of companies had that, right? But what's attributable to the ESG change as opposed to other changes in the economy?
Like creating causation effectively. Right?
Sure.
So-
I mean, I think a lot of it's the demand pull from investors that are causing more companies to realize that they have to wake up and actually start paying attention and measuring what the impact that they have on the planet, on the environment, as well as understanding the impacts that they're going to face from externalities. So I do think that there's a bit of that investor pull, and it's also risk mitigation. But I mean, there's only 3,000 companies that on a regular basis report their ESG performance. And I think that needs to obviously grow. We're going to have challenges as you go down that long tail of smaller companies, private companies. And actually, this is a question back at you, but in the absence of that information, what can we do to help? I mean, one thing that we do in TrueCost is we model. A lot of our data is based on modeling because there's 15,000 companies that we cover, and only 4,000 of them actually report. So, I think it's also it's a question back really to the audience is, how can we get...
What part of those companies actually can have ESG that affects their bottom line? Is it so small or so large, depending on the kind of business you're in, or is it in total?
Well, I mean, the way we look at it is you have to look across sectors, right? Because every sector is going to have a different set of issues that impact their business. And those issues are going to have different, attribution or weightings. So, I mean, one way we look at it is we've been trying to collect data for many years and back testing that and actually trying to measure is GHG, should that be 30% of the weight of how we measure a company's performance? So I think there's some more science and math that needs to go into this, certainly. But there's a whole lot of work going into that now.
Marc, I can see
one thing I'd add, I mean, it's the old question of like BP, is it a renewable company or not? Right? I mean, they have a huge renewables portfolio, but they also drill oil. So I don't know. Right. And I think that's an inherent challenge in the public markets.
Sure.
Again, from the private market side, we look at it, I don't think it's easy, but it's a little bit more streamlined because when we're looking at companies, for example, we have one strategy, we're investing in renewable energy assets. We're buying solar fields and wind farm and wind plants. It's pretty clear they're generating clean electrons, and so it's very, very, it's very specific. And so for us, it's very easy to say, yeah, the economic whatever economics are generated out of that plant, it's clearly attributed to the clean energy. But in the public markets, it's a lot harder to really isolate those impacts, I think. That's why I stay in the private side.
I know we have another question over here. If I could just take this one, then I'll come back to you in a second.
Hi, this is a great panel. I'm Brian Reynolds. I run a small consultancy that advises on carbon and climate and sustainability. I want to drill into, I think, the underlying question, which is for thousands of years of human history, anybody who's been given the chance to self-report has not done a particularly good job of it. And I'm interested in ESG as a proxy for is this company well protected when eventual regulation comes and prices go up? How confident is this panel in the numbers that are being reported? And I'll only remind you that this panel probably represents on Earth today the people best represented able to answer that question. So if you can't, we're all in a little trouble.
Regulatory risk. Marc, is that one high on your list?
It's difficult. So you're right. There is not a lot of consistency in the information that's reported today. When I've talked to companies, some of the larger companies tell me that their IR teams are spending 40% of their time delivering ESG data to investors like us. We're asking for different data. We're asking for the same data in different formats. They want a standard. They're willing to deliver the data. They just want to know, just please tell me what to give you, and just all of you please ask for the same thing. So the answer is, I don't know that we have a good handle on how accurate some of this data is because of the way it's reported, the way it's collected, and the different variations on that. I think the idea is we probably at one point need to drive towards that. We've gotten there more or less on the financial side of things. We're just in the infancy on the ESG side of things.
I think one roadmap that is important to watch is the European Union and their taxonomy that's being implemented at the end of this year. That's the first kind of widespread government-supported initiative to create standardization in the market. And it has created, to your point, a lot of companies and asset managers scrambling to meet those demands. In the US, there's no large-scale government-supported initiative, but there are really important self-regulatory organizations with clout, PRI, SASB. Those are increasingly important because they represent trillions of assets, and companies listen to those organizations. So we're relying on those for now to really drive that standardization.
I say also the more you ask and the more you demand that data, the better that data is going to become, right? I think the initial, and I'd be curious, right, probably 5-10 years ago, I'm sure, oh yeah, here you go, here's the data. Now they're spending 40% of their time pulling that. I mean, that's a big number, and that's a lot of effort for IR to be doing. So I think it improves the more the demand is there.
We'll squeeze in a question here.
Hello. Hi, Joe Kitterman. How are you?
That works.
There's a lot of people that are saying, we've been doing this for a long time, 10, 14, 15 years, and then there's this huge gap between the entire wealth management and financial advisor and broker community, where less than 6% of advisors have any interest in even talking about ESG with their clients. And you guys are the experts, and unless you spend a lot of time reaching out to that community and sharing with them that you've been doing this for 14, 15 years and this isn't a trend or a fad, they're not going to take up the challenge. They need tools to be able to talk to their clients. They're not getting those tools. They need to get them from the people that are on the stage today. They need deep education because there's a gap of 88% of clients interested in doing this investment, and only 6% of advisors that even talk halfway intelligently about it. Are any of you guys doing anything to try to bridge that gap?
So I would say we have a distribution team, and so it's our sales force effectively, and we have some in the room, and that's what they spend their day doing. They spend 100% of their time going and knocking on doors and trying to explain to them, and these are folks that are dedicated into the sustainable space, spending their time talking to asset allocators, talking to other RIAs, talking to folks to try to get them to understand what it is that's happening in this space, and that this isn't concessionary, and trying to debunk some of these misconceptions that have been embedded for so long in investors' minds. And so, we are doing that, but we're one of many. So, and I would imagine we're not alone in that effort, but it is an effort that we do pull on.
Can I get a question in here from? We'll get a microphone over to this table. Thank you.
So how?
Just flip
Maybe
the switch up.
There we,
I think you're good.
Hello? It is? Okay. Helen Sahi with Armstrong World Industries, where we make acoustical ceilings and tiles, but I actually worked for Bank of America for 17 years ago. A comment and then a question. I mean, if you haven't read it, in January, Brian Moynihan presented, the CEO of Bank of America, actually presented a paper that was completed for Davos, because he leads the CEO Forum for the International Business Council, and it talks specifically about metrics and the fact that it's important to have ESG metrics. The problem is everybody's measuring different things, and it's okay if if a true cost puts their own value judgment on those ESGs, but let's all measure the same thing. So there's actually a huge body of work that's being done around that. I mean, Ernst & Young, PwC, KPMG, they were all involved in helping pull this together. And there are things beyond a DJSI that are measuring just within a sector. I mean, there's a whole body of work called the Future Fit Business Benchmarks that looks at just that and says, if you're going to measure greenhouse gas emissions, me as a building sector can measure myself against a financial sector, against a flooring sector, whatever it is. So it's normalizing that and looking at science and context-based. So I would encourage everybody to look for that paper. It's probably about 79, 100 pages long, but it's worth a read. And we have HSBC's CEO speaking later, so really curious to see. One, I didn't go in and see which CEOs are on the IBC, but probably all or most of your CEOs are on there, and how that's trickling down into what you're looking at to normalize it, you know, similar to what Michelle was talking about before.
Any takers? This is the. I am intrigued. Okay, Kevin.
Yeah, I don't know. I'll take a shot. I mean, look, I think we're in a little bit of the weird place where, back to the data point and standard and framework points, where there's still a bit of a development as to what is the right standard and is there a commonality about it. We have existing frameworks that have been out there for some time: GRI, SASB, TCFD. Even other reporting organizations like CDP and other things like that. So it's not unclear how that all shakes out as to does one consolidate down into one standard. I mean, the reality is, though, there also are market drivers here, and there's businesses that are being developed to create those types of standards. And so I think it will ultimately come back to what investors truly find valuable, and then it will coalesce around those types of metrics where there are, frankly, more disclosure, but are on fewer things that are more materially important, because that will help both investors make decisions, but it also help companies not feel overloaded with having to report on a wide variety of metrics that may be irrelevant for their sector. But I don't think there's a magic bullet today on what that looks like. And so, we'll see some evolution, I think.
Right, we've managed to run over time, so I better wrap it up. Tansi asked me to give a very brief kind of summary of the discussion. Trying to read my own notes here. Sustainability begins at home. I was struck by the number of people who talked about what they were doing inside their own organizations. ESG is being driven by risk mitigation, by the belief that there is a return on sustainable investment, and by the hope of impact. It's also being driven by consumer shifts and demographic shifts. Data may save us, but there's still a lot of confusion around the data and the metrics that are going to be the standards. We need to address the world today, as Michelle put it, and this is the moment when the real test comes after a long bull market. We will continue to be grappling with these themes in Moral Money at the FT. If you sign up at ft.com/moralmoney, you get 30 days free access. That's my plug. More importantly, I want to thank this excellent group of panelists, and I want to thank our host, Tansi, for a terrific discussion today. Thanks.